What's up, everybody? Welcome back to another episode of Financial Freedom Fastlane. And remember, the quicker you get to your dream life, the longer you get to live it. And I'm your host, George Achampong. And on today's episode, we're going to break down tax diversification, how you can save over $400,000 in taxes during your retirement years if you set up your investments the right way. Oftentimes, we hear people talk about diversifying and buying different asset classes, whether it's real estate, whether it's diversifying different types of stocks and bonds and ETFs. But we often don't hear about what it means to diversify against the risk of taxes. Many people don't realize this, but we're actually in one of the lowest marginal tax rates that we've ever been in history. I think the second lowest, to be exact. What does that mean? That means if I was a betting man and someone asked me in the future, do I expect taxes to go up or taxes to go down? I would likely say that they will go up. Why? Because at the end of the day, the government has to find ways to cover the expenditures that they have. And oftentimes that comes by virtue of tax revenue. So what does that mean for you and me and people who are trying to invest their money and build wealth and preserve it for the long haul? Tax diversification is going to be key. So the first thing I want to touch on is the three different aspects of tax diversification. When you think about where your money is going to be invested, number one, you can invest your money in taxable accounts. What does that mean? That means the money that goes into the account was already paid from after-tax dollars. If I experience a gain on that account or I have a dividend or receive a dividend, I'm going to have to pay taxes on that money. And that's not inherently a bad thing. These accounts have the most flexibility. It is not necessarily earmarked for retirement. You can contribute as much as you want. There's no contribution limits, but it does not necessarily have any advantageous or favorable tax treatments beyond the fact that if you hold it beyond a year and a day, then you can benefit from long-term capital gains tax. So that is one account type. So when we're thinking about investing our money, if we want to maximize and optimize for flexibility and being able to contribute as much as we want, then a taxable brokerage account is probably going to be something that we want to include in our strategy. However, if we have the desire to decrease our taxable income today, then the next bucket of accounts are going to be our tax deferred accounts. These are accounts where the money goes in on a tax deferred basis. It decreases your taxable income today, but when you need to distribute the money at retirement, you're obviously going to pay taxes. The way I always like to explain financial planning is kind of like apartment or house shopping. Have you ever seen a house that had the best kitchen you could ever imagine, but then you went in the primary bedroom and the closet was kind of tiny, right? You went in another house and it had an amazing wraparound walk-in closet, but then the kitchen you didn't absolutely love. And that's kind of how these different account types are set up. You're going to get some features and benefits with some and not with others. And that's why it's not an either or conversation. It's a both and conversation and understanding where it fits in the mix for your respective strategy. So when it comes to our tax deferred accounts, these are going to come into play when we want to decrease our taxable income today. We understand the money's going to grow on a tax deferred basis, meaning the growth is going to continue to compound. But when we want to access the money, we are going to have to pay taxes. These are going to be accounts like your traditional IRA or your traditional 401k account. Oftentimes people will talk junk about these account types and say that your money is locked up. It's not a good account to invest in. And it's not that it's not good. It's just a matter of understanding where it fits in the overall strategy. Then we have our tax-free accounts. And when I say tax-free, I mean from a distribution perspective. So this is going to be like our Roth IRA or Roth 401k. The money that goes into this account, we already paid taxes on it. Now it's going to grow on a tax-free basis. And when we want to access the money, it is no longer going to be taxable. So we love a Roth IRA when it comes to the strategy of distributing more money in retirement while minimizing our tax burden. Now, essentially, there are three phases of wealth. You have the accumulation phase, you have the distribution phase, and then you have the preservation phase. Many of you watching this video are likely in the accumulation phase. And this is when we are trying to stack and invest as much money as possible. Then at some point, we don't want to just stare at the money in our investment or our bank accounts. We actually want to be able to live off said investments. And that is when we enter the distribution phase. And how good that distribution phase is going to be is largely contingent upon what we did in the accumulation phase. And I don't just mean how much money we got invested during the accumulation phase, but where we invested the money, which speaks to the tax diversification piece that I spoke about previously. If we put 100% of our money in tax deferred vehicles, what does that mean? Yes, through our working years, we were able to decrease our taxable income, but on the back end, that means that I'm going to have to pay taxes on all that money. And like I said earlier, if tax rates go up, that could be problematic. So we want to make sure that we have a strategy that's going to allow us to diversify against that risk. And last but not least, many of the clients that we work with, they have a goal of generational wealth. What does that mean? That means that we want to make sure that we're protecting and preserving their wealth to be able to pass it on to the next generation. And guess what? If we are not mindful about the tax implications of where the money goes in the first place, then that inherently is going to set us up to not be able to leave behind and preserve as much wealth as possible. To validate this concept, let's go into an example. So we're going to go with client A and client B. And hopefully my amazing video team can put some illustrations on the screen, because I know what I'm about to walk you through is going to be a lot to digest with just words. Client A is ready to retire, and they realize that they need $100,000 at retirement in order to have a successful retirement lifestyle. Client A put 100% of their money in what we call qualified retirement accounts, meaning that it's going to grow on a tax deferred basis. Technically, you say grow on a tax-free basis and to be distributed on a taxable basis. So that means the same way you have your paycheck today, when you get ready to get that paycheck, you have to pay taxes on it. You have your gross pay and you have your net pay. The same thing will hold true for your retirement account. So when you say, I'm going to take out $100,000 from my retirement account each year, what you're really saying in this example, for all intents and purposes, is you're going to net out about $70,000 after taxes. Now, of course, if you're working with me and my team, there's likely things that we can do to offset that tax implication. But for all intents and purposes, let's just keep it standard. So now you're going to receive $70,000. You're going to pay $30,000 in taxes. And so there's a couple things that we notice here. Number one, our net income decreases by $30,000. And then if we're paying that in taxes over the course of the first 20 years of our retirement, that means that we're going to pay out about $600,000 in taxes in the first 20 years of our retirement. So I decreased my income by $30,000 and I paid over $600,000 in taxes if I were to have all of my money in qualified retirement accounts. Now, let's look at client two. Client two still wants $100,000 to come out of their accounts, but the difference is they focused on where they put the money during their accumulation phase. So this particular client is going to distribute $50,000 from their qualified retirement account, and then they're going to distribute $50,000 from their Roth IRA. So when they take the $50,000 out from their qualified retirement account, they're taking out 50% less money than the client who took out the full $100,000, which means that's going to put them in a lower tax bracket. So they're going to pay about 20% on that $50,000, which inherently translates to about $10,000 in taxes versus the person who paid $30,000 in taxes. Now, the other $50,000 that they're distributing is coming from a Roth IRA, and they've already paid the taxes. So that means they're going to be able to see the full $50,000 from that distribution. So if we look at the $40,000 from the retirement account and then the $50,000 from the Roth IRA, that means their net income is $90,000, all because they understood where to put the money in the accumulation phase. So the first thing you should notice is that they're going to receive $20,000 more in real income than client A because they have the money distributed from two different account types that have two different tax treatments. So $20,000 more in income, even though they were starting with the same amount of money that they were distributing. The next thing you'll notice is that client B is only paying $10,000 a year in taxes versus client A who's paying $30,000 a year. So client B, over the first 20 years of their retirement, is paying only $200,000 in taxes versus $600,000, which means they're inherently saving over $400,000 in taxes, all because they understood where the money should go in the accumulation phase. I often say that many people only focus on climbing the mountain, but many people don't focus on how they're going to get down. You never met a person in history who climbed the mountain who didn't have the intention of coming back down the mountain. So when we think about accumulating wealth over our time horizon, over our lifespan, then we need to be thinking about when I get to that point of being ready and able to distribute the money, how do I distribute as much as possible by paying the least amount of taxes? So it's not enough for us just to say, am I diversified with my investment selection? I also have to be diversified with the tax treatment of the investment vehicles that I select. So if you want to make sure that you don't overpay in taxes and that you can build more wealth, I hope this video was helpful for you. And if you want to see more videos like this, leave a comment, share it with a friend, and make sure you subscribe to our YouTube channel, because this is going to help the algorithm know that you are interested in more videos like this. And remember, freedom is for sale if you're willing to pay the price. Thank you for tuning in to another episode of Financial Freedom Fastlane. The quicker you get to your dream life, the longer you get to live it. And I can't wait to see you on the other side of wealth. Peace.